Hi there, Mike Braid with Generosity Wealth Management, a comprehensive full-service financial services firm headquartered right here in Boulder, Colorado. You can see from the backdrop that I'm still self-isolated at, Generosity Wealth North Boulder headquarters, which is also known as my home office. So hopefully all of you are doing well. I have some random thoughts today, and the first one is something that I periodically hear from prospective clients over my last 30 years, which is I want to be invested, but I just don't want to lose it all. I'm fearful of losing all of my my portfolio. Let's deconstruct that and talk about that as a fear or as a concern. In a diversified portfolio, and you should have a diversified portfolio, you're invested in hundreds of, if not thousands, of various issues, whether or not that's stocks or bonds or whatever that particular portfolio is, whether it's conservative, moderate, aggressive. It's invested in hundreds, like I said, or thousands. And in order for that portfolio, that pool of investments to go down to zero, all of them would have to go down to zero. All of the manufacturing companies, all the technology, all of the oil, all of the service, they'd have to go down to absolutely zero. Can individual sectors go down at certain points? Absolutely. Can individual stocks go from something to bankruptcy? The answer is absolutely. That's why you shouldn't have a portfolio comprised of only an individual stock or just a few stocks, or just some specific sectors. It just doesn't make sense to be that undiversified. Having a diversified portfolio does not guarantee against having market ups and downs. And right now we're seeing some of those market downs. Does not, protect you fully from that. But in order for it to go down to zero, all of the underlying investments that comprise that portfolio, which would be hundreds and thousands, and the most common names and common stocks and companies out there would all have to go bankrupt and down to zero. So hopefully you can see that that's just not very probable. Okay, and if that was to happen, we truly would have an Armageddon here in the United States. The economy and the market are not necessarily the same thing. In March of 2009, March 9th to be exact, was the absolute low for the stock market. At that point, if I was to say to you, over the next 8 years, we're going to have 2 presidential terms, 2 4-year terms, for the very first time, where an economy that's going to have a sluggish recovery and never be greater in any of those 8 years, a GDP growth of over 3%. Never happened before. 2 4-year terms for a presidency where the GDP didn't grow more than 3%. And it's not Obama's fault. This is not about Obama. I'm just using that as a benchmark, that the economy is going to be sluggish and it's never going to be over 3%. And oh, by the way, I want the best thing that you can do is invest in the stock market. You'd say, that's crazy. The economy is really, you're telling me the economy was sluggish and the stock market's going to be great? The answer is that's exactly what happened. It was almost a tripling from March of 2009, almost a 300% increase during the next 8 years. The stock market, the bond market, those unmanaged stock market indexes, the S&P, the Dow Jones, etc., they're what we call forward thinking, what investors believe is going to happen in the future. And sometimes they get it right, and sometimes they get it wrong. In the 2008, 2009, I would say that it was oversold, because you can see that what they thought was going to happen, that the economy was going to be even worse, and then they realized, wow, we overshot this thing. We overshot, and then it was a buying opportunity. If I was to ask the person on the street, if I was to ask you who the best investor of all time is, most people would say, well, Warren Buffett. I mean, Warren Buffett, of course. If you have some longevity, some in the markets, you might remember Peter Lynch, who retired, about 25 years ago. You might say Peter Lynch. He worked at a big mutual fund company. Both of them believe that, and this is a direct quote from Warren Buffett, be greedy when others are fearful, fearful when others are greedy. And so I wonder, what do they know? What do I know that they don't know if I do the opposite of what they say? They're very smart investors. They believe that, and I do as well, that you make decisions with your head and not with your stomach. Because the stomach, when you do that in the midst of difficult decisions, you make bad decisions. That's why you have a multi-year plan that you stick with that I've talked about in some of my previous videos. It's just very important that the economy is not necessarily completely indicative of what the stock market's going to do, and that we make decisions with our head and not with our stomach, because that leads us down the wrong path. If we had perfect foresight, we would know what to do, but none of us have perfect foresight. I have kind of in my mind, I've thought about that there's two different types of people in the world. And this applies to so many different areas. When I talk with people about unintended consequences and potential consequences, there's one type of person who says, hey, I'm not going to actually do anything until I know it's going to have a positive outcome. I'm going to look, I want to know, not 100%, but I'm going to have a pretty high probability that the action I'm going to take is going to have the positive outcome that I want. There's a second type of person who says, I've got to do something. I mean, if it has an unintended consequence and it might even be negative, well, at least I'm moving forward. At least I'm taking action. And not taking action, particularly when we don't know the consequences of that action, is sometimes the most difficult thing to do, is to not do something just so that we can feel that we're doing something. If there is an action that someone wants to take, it's a systematic rebalancing. The problem with that, meaning that maybe your stocks or equities have gone down, it's increasing the equity exposure, doing the exact opposite of what your emotions might actually be telling you at this particular time. So if there's some action to do, it's actually to reevaluate, wow, maybe my stock and equity portion has gone down. Maybe it's time to rebalance to buy more of that. That is a question that should be asked and that you can think of. I've said for many years, as part of my random thoughts here, I'm just going to go that some of the most difficult times to talk with an investor, to make investment decision, is when you've made lots of money and you've lost lots of money. And it has everything to do with your mindset and the behavior that you're bringing to the decision. If you've made lots of money, you might have just been lucky, but you have overconfidence in that particular, in yourself, in your decisions. If you've lost lots of money, it's the opposite. There's a fear that that's always the way it works, and it just doesn't work that way. Most years have a 10% decline, okay? I've thrown up on the screen, not now, but in previous videos, that you'll see that that's the normal, that there is a correction of 10% in most years. There is a 20% bear market about 1 out of every 4 years. There is a large correction of 30 and 40%. Let's just kind of look back in 1973, 74, in 2000, 2001, 2002, in 2008, 2009, that time, and then right now. When we look at all that, we're talking about once a decade, okay? The 70s, the early 2000s, the late 2000s, and now. About once every decade, and in every single time, it has recovered. Maybe not exactly when we wanted it to. Of course, we want it to go away next week, next quarter, next year. And it might. I doubt it's going to happen tomorrow. But it has always come back, and it's about once every 10, 15 years. You'll notice that I didn't say 1987. 1987 was actually a positive year for the unmanaged stock market indexes. Everyone thinks that it was just, it's because it happened very quickly. It just wiped away a year's worth of gain, but actually ended the year positive. And then the years after that, the next couple of years were positive as well. So it's good to keep everything in perspective. That's why I'm always talking about the long-term vision. I said something in my last video about point A to point B, and the reason why I bring that up is point B is not retirement, okay? It's not outliving your money, or not outliving your money, you and your significant other's money. It's might just happen to have a retirement event inside there. So if you're 60 years old, just arbitrarily picking 60 years old, your point is not 65 years old. It's until for the rest of your life, because you don't want to outlive your money. But during that time frame, you just might have some life events that happen. Your retirement, perhaps the loss of your spouse or significant other. There's lots of major things that happen during your life expectancy, or when you add in your spouse or significant other, both of your life. So it really does boil down to even having longer time horizons, even when we're close or already in retirement. That's why it's good to say we have multi-year strategies. It's good to keep that in mind. That's why you do all the work before something like what we've seen in this past month, which has been very bad, not good at all. You do it before that happens. Steel yourself for those decisions, and 5 and 10 years from now, you'll say, it absolutely was horrible while I lived through it. I sure am glad it's over. It was a painful lesson. I hate that. But you know what? The best thing that I did was I did nothing at that point. 303-747-6455. You have a wonderful day. Call me at any time. Bye-bye.